2016, there was a lot of volatility in the market. It started off the year with financial market volatility emanating out of China. So the first part of the year, there was a lot of disruption associated with rising spreads and economic uncertainty. And then the remainder of the year, there was a lot of political uncertainty related to the Brexit vote in the UK and then the election in the US, along with the implementation of some Dodd-Frank rules for the CMBS market. All those things I think served, along with concerns around real estate markets and whether prices have peaked and how close we are to the next downturn, I think caused some sobering of the market last year. As we start 2017, I think, in the broader financial markets, you've seen a lot more confidence, and as a result of that, you're seeing more activity and maybe more confidence in the capital markets, and more confidence in terms of likely economic growth during the year. So I think 2017 is starting off in a very positive fashion. The market sentiment seems to be that it's going to be a very positive year, maybe driven by some of the policy changes that are expected in Washington, in addition to continued health in real estate markets and continued balance in terms of new construction versus demand in the markets that we're operating in. So our view this year is things look pretty positive. We're hopeful to invest at least as much money this year as we did last year, and think that 2017 is going to be a very good year. I still see market discipline around underwriting standards of loan-to-value, debt service coverage, projections around property performance. I think there's still, good market discipline around those areas, and so we feel pretty good about, the types of loans that can be made in the marketplace today, and the likely performance over not only the first few years of the loan, but, the long term as well. The industrial warehouse market has really been the property type that we've been trying to do more of, and I think others have been trying to do more of. In part driven by the fact that the whole e-commerce phenomenon is driving demand for warehouse space, and so you're seeing a lot of expansion in that sector. A lot of some supply being built, but also a lot of demand to fill the supply that's being constructed. And as you look forward, sometimes it's difficult as a lender to find enough industrial loans that supply the appetite that you have, and so that's an area that we'd like to see more activity in from our perspective, and I think others sort of feel the same way. Maybe the flip side of that is retail, which is affected in the other way, and I think when you look at the retail environment, particularly the B and C malls, those are much more difficult to finance today than they would have been a couple of years ago. Even the CMBS market, I think, is being more selective about those types of deals, and so it's a more difficult property type to find a loan for in today's environment. Certainly we give a lot of thought to how technology was going to impact the real estate that we finance. We talked about impact on retail already, but as we look forward and you start to think about things like driverless cars and what impact that has on the parking needs at the types of properties that we finance, those are all the kind of things that we think about. The wiring for buildings that we finance, how it's going to impact ability to tolerate future technology needs. All those things are part of the analysis in making loans as well. So technology kind of permeates everything we do, and I don't see that changing anytime soon.